Are there moves that you should be making in your portfolio in the event the economy does indeed cool? Joining us now with some tips is Aaron Gray. He is a wealth advisor at Buckingham Strategic Wealth. Aaron, welcome. Nice to have you here.
Hello, Sue. Happy to be here.
You make the point that the time to take a look at your portfolio and assess your risk is when things are relatively calm.
That's right. It's really any time is a good time to reassess and validate that your portfolio is adequately diversified and kind of in the right balance in terms of the amount of risk that the portfolio carries and what you're comfortable with experiencing. I think specifically in terms of the diversification, you want to double check, make sure that within your equity or stock exposure, you have both U.S. and overseas. You want to make sure that you have both small and large value growth. You want to really kind of maximize diversification, and I'm talking specifically within the stock side of the portfolio. But in addition to that, it's going to make sense to have fixed income, maybe a little bit of cash, and even maybe some alternatives, other asset classes that don't have correlation to the stock or bond market to get you really kind of the maximum benefit of diversification.
Are you talking about things like gold?
Absolutely. Commodities would be a part of that. And there's other asset classes out there, other managed strategies that can demonstrate the ability to march to the beat of its own drummer, not necessarily go up or go down with the stock market. It will experience its own volatility, but to the extent that we can put more asset classes together in a portfolio that demonstrate that non-correlation, it's just going to smooth the line over time and make the volatility of the total portfolio less.
One thing that we've found in the past is that investors who have made a decent gain in the market tend not to reallocate, even when they have made a significant advance. Do you recommend looking at your portfolio and if you've done well, change things around a little bit or no?
Absolutely. That's a great point. We have a tendency, once we have winners, to let those winners run. And for example, if you had a target allocation of, say, maybe 50% stock and 15% alternatives and 35% fixed income, if you set it and forget it, eventually that portfolio is going to look very different than what your primary target was. And if you like that 15-35 mix to begin with, you're not going to own it for very long because stocks will go up and bonds will go up and go down. And before you know it, you have an 80-10-10 portfolio. So what you want to do, really, no matter whether the market is up and times are good or the market's down and times are a little bit scary, is continuously check in on that portfolio and see how far away from your primary targets you've drifted, and be prepared that when the market's up and everybody's excited and slapping high fives, to go ahead and sell some of that stuff that's up and take your profits. And then on the other end of that spectrum, when the market's down 20% and we're on TV talking about how scary and uncertain things are, we need to be prepared to actually buy then and buy those things that we're uncertain and a little fearful of. That is rebalancing at its essence.
Aaron Gray with Buckingham Strategic Wealth. Aaron, thank you so much.
Thank you.